Over the last couple of days, we've seen a significant break to the upside in the strength of the US dollar. Maybe it's time to look at why the strength of the dollar is going to have a very negative impact on US growth, but also global activity levels. Since the great financial crisis started, the foreigners created additional $20 to $30 trillion worth of debt funded in US dollars. As the dollar goes higher, as the Federal Reserve continues to indicate that they perceive a higher interest rate needed, the cost of actually carrying this debt on the books increases for non-US citizens and corporations. This is creating pressures on what we call the currency deficits. And as John Hardy and I have been writing about on Trading Floor, we are right now short currencies like South African Rand, the Turkish lira, Canada and Aussie based on this, because the countries that borrow the most is most exposed when you see this kind of environment. So the combination of Federal Reserve now having 67% likelihood of increasing rates in December, the money market funds reform that comes into place the end of this week, and the fact that the dollar overall is breaking technical levels together with the fixed income breaking technical level is a warning signal to the market that potentially even more dollar strength is coming. So remember, the rule of thumb is that a strong dollar will lead to a US recession ultimately. Federal Reserve is now trying to continue the path down higher interest rate, but that high interest rate is almost creating a certainty that recession is increasing in likelihood in 2017 and probably already as close as in first or second quarter of 2017. So play the dollar long from this perspective into year end, but ultimately we see this as a final leg of dollar strength before we think there will be a massive weakening of the US dollar into the US recession.